All right, welcome everyone to Wook Capital Management's 12th rendition of our Wook and Review broadcast. Just need to get a disclaimer out of the way before we get things going. Need everyone to be aware that Wook Capital Management Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from their professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results, and all investment decisions of an individual remain the specific responsibility of that individual. All right, with that out of the way, we're going to have our second to last Wook and Review of the year. We're going to be talking a little bit this time about nearshoring, reshoring, onshoring, whatever shoring you want to refer to it as. This idea of an ongoing manufacturing and good production out of China and back toward either different parts of Southeast Asia or to North America. So we'll look at a little bit of data around that, go through some of the different highlights from this week. So just as a reminder, we do have our second book club meeting coming up on Tuesday. We did have to delay it from this week to next, but it'll be on Tuesday the 13th at 7 p.m. Eastern. So we're going to be having just a spaces discussion on Howard Marks' The Most Important Thing, which is a collection of his investment memos where he discusses various themes around just how one's investment thinking should be conducted. Really some great discussions around risk, what is not risk. And yeah, look forward to it. Hope to see some of you there. So we've got that coming up next week. We had a few different items come out this week. We did host an earnings call live stream overlaying the GameStop earnings. So we did that. What was that? Wednesday, yesterday. Lose track of time. But we discussed GameStop's earnings. They continue to realize operating losses. Still not really seeing too much evidence of the vaunted turnaround that they have been preaching that they're undertaking, but they reiterated an expectation that they'll realize profitability in the near term. So for those who are unaware, Wook, really made as a byproduct of the crowdsourced investment research that went into GameStop throughout 2020 and culminated in the GMEDD report we put out in January of 21 and then continued publishing throughout 2021 and this year. So Joe did have the opportunity to interview Ryan Cohen last month. If you didn't get to catch that, the chairman of GameStop, the founder and former CEO of Chewy.com. So Joe had a neat interview with him. If you didn't see that, we'd love you to check it out. But yeah, so keeping it scrolling. We've got some new rules from the SEC, just to kind of make sure folks are aware. I have visuals that I'm sharing in our Discord. So if you're listening to this live and you want to see the visuals as opposed to just audio, I'm going to refer to some visuals and I'll try to paint the picture vocally. But if you're a visual learner like me, maybe you'll prefer to pull that up if you're on your laptop or on your phone. But that's in wook.gg. We'll bring it to the Discord if you haven't joined it yet, and it's in the voice chat is where I'm streaming visuals. But if you're replaying this, you're seeing it on YouTube, that is irrelevant. So anyways, there's been this ongoing proposal of some new rules from the Securities and Exchange Commission regarding retail trading. As I'm sure many remember, there was the January 2021 mania. There were all of the bottlenecks that happened in a variety of companies' settlement processes and margining requirements and the like. Some brokers, took actions that users felt were just out of line with what would be appropriate. So, we're now at a point where next week the agency has a meeting and they're going to be evaluating these 4 different proposals that could reshape how the market operates. So things like the national best bid or offer, different things for market orders, which, personally, I'd never recommend anyone to ever use a market order. You should always use limit orders if you can help it, is my view. But for folks who do use market orders, there may be some changes to the rules, and that'll impact trading. But again, from an investment perspective, this is quite irrelevant to one's investment thinking. But it will be interesting to see what the SEC finalizes on these rules. Virtue and Citadel, and some of the brokers that do take PFOF, payment for order flow, think that these changes are unnecessary. They've campaigned against them. Mr. Gary Gensler, the chairman, had at one point talked about banning that. It seems like that is unlikely to transpire, but we'll see what happens after next week's meeting, and there'll be a statement period wherein folks can provide comment to the commission on how they feel about it. So that's going on, which is related a little to GameStop, the GameStop saga. All right. Next item, asset bubbles popping. So I put a couple charts in. I made a graphic just combining the 30-year fixed rate mortgage average and the S&P Case-Shiller National Home Price Index. So you can see the blue line reflecting home prices, and I made it go back 20 years, about 20 years, to around 2000. So you see we had this massive run-up in home values from pre-COVID. The index sat at, let's call it 215, and now the index is at 300. So it's still significantly elevated over where it was pre-COVID, talking housing prices. You can see the red line of mortgage rates obviously have skyrocketed over the last 12 or so months from under 3% at points in late 21 to now breaching 7%, although they've cooled off a little bit in the last month or so here as financial conditions loosened back down to the 6 and change mark, but still more than double where they were a year ago. So major headwinds in real estate, and you see the blip of prices just beginning to decline, and that is the question mark. That's the trillion-dollar question mark, is how far down will prices go? Will they retrace most of their increase? Will it just be some? Will it go past where it was pre-COVID? I don't see too many folks forecasting that, but it does feel like housing has more to go. And there's obviously been plenty of reporting on it. Earlier this week, Nick Timmeros, the Wall Street Journal, is their head economics correspondent, and people like to call him the Fed whisperer. But when he writes things, I've always enjoyed reading his writing, even going back to the Great Financial Crisis. When I was an undergrad, I enjoyed reading his writing. And there's just some data in the story that I have up from Wednesday, just kind of talking about where things stand. I mean, you've got some quotes from different market participants, right? A good one here from this chief executive at Redfin: when prices are rising, people can't believe housing will ever go down. And then once prices fall, they can't believe it will ever go up. People like that with stock prices too. But housing, certainly, it did soar. I mentioned those numbers from an index perspective. Using a percent might be a little easier. Home prices rose that 45% from pre-COVID, Jan 20 to June 22, and we've really only let a little bit of air out of the balloon. So you can see the graphic on the screen for existing home sales. Sales have fallen through the floor, right? Sales are down almost 30% year over year. So the price has to still follow, and there's still, I think, a lot of pain left on the price side. For example, a few different forecasts. You have KPMG, which is one of the big four accountancies, of course, calling for prices to fall 20% next year. Goldman Sachs, a much more muted 7.5% next year. National Association of Realtors, as I think is quite fitting, sees prices increasing next year because, what else are they going to say? And the Mortgage Bankers Association also sees price increasing about 1%. So they both don't see prices going down, which, fittingly, what are they going to do? Tell their clients that prices are on the decline and they should wait to buy. A little tongue in cheek, but you see the spread ranges from flattish to down 20, and of course, no one knows where it will go. But given that it's still 40-ish% above pre-COVID, that would only be getting us halfway back-ish to where we were. And obviously, that large expense, housing is most people's largest expense, so it does eat away as in what they can spend on other discretionary areas. So we could talk a little bit more about that once I get through the prepared content. Really, I'd be happy to have anyone come up who wants to have a discussion on any of the content we discussed from this week's presentation. We'll see. If we don't have too much to talk about, we can always end the call a little early. Otherwise, I expect to get through the prepared content in about 20 minutes here and run the call till at least 5:30, participation depending. So, yeah, you got that going on in the housing market. And then on the other big asset in most people's lives, automobiles, you've still got a lot of downside, it seems. I pulled up the Manheim Used Vehicle Value Index. So this is as of November, the latest data point. You see that the index is at 199, and that compares to around 140 pre-COVID. So you got, again, 30 plus 40% above pre-COVID levels for used automobile values. There's been a lot of weirdness in the automotive space because of the ongoing issues in supply chain. And of course, our topic today is pertaining to supply chain. So we'll kind of take that segue in a minute. But you have a lot of constrained production on the automotive side that occurred. I'm just pulling up an article from yesterday in the Wall Street Journal talking about what auto dealers are thinking about. So, of course, the headline reads, "Auto dealers gird for softening demand amid higher rates, uncertain outlook." And it's hard to understate. If you're borrowing $50,000 on a car loan, going from a 2% loan to a 7% loan, that incremental 5% on 50,000. I mean, we're talking a whole lot of money. That's an incremental $200 a month in terms of your monthly payment. So that's $200 that otherwise could have gotten saved, could have gotten consumed, whatever. And now it's simply going to that interest on that payment, right? And obviously, most auto loans are fixed rate. So if you're in the market now, that's unfortunate. If you were in the market, you're probably locked in, although you probably overpaid, right? Because prices of used vehicles had been quite high. They still are. So the dealers still kind of just from this survey data, see, I guess, glimmers of hope, right? There's comment from the CFO of General Motors that there's probably some pent-up demand out there that's going to continue to work itself through in 2023. And that makes sense. Supplies are still pretty limited because of the bottlenecks are really just getting themselves worked out now for many of these automotive OEs, at least on the ICE side. We could talk EV, and there's still a lot of challenges from an EV supply chain perspective. But you basically got a big decline in buyers paying more than sticker price. So I had pulled up one other graphic. I didn't include it in the newsletter. If I can get my screen to work, I'll pull that on the screen. Basically, too many. Okay, there we go. So basically, this is a visual that I pulled from S&P Global, and it's got, the headline is that price hikes for electrified vehicles outpace combustion counterparts. So I'm sure many of us have heard about the price increases for raw commodities that have impacted batteries. On Wednesday, during our market open mic, we talked a little bit about Bloomberg coming out with their newest, their most recent battery survey, where they survey global OEs and battery manufacturers, and found that for the first time since the survey began over a decade ago, prices had actually increased for the cost of battery packs and battery cells on a year-over-year basis on average. So that chiefly driven by the cost of the cathode materials, the anode materials, which are cathode materials are the single biggest line item in a battery cell cost, obviously push price up. And you can see the graphics I have on screen show the delta between and the changes in price between new electric versus non-electrified vehicle sale prices. So going back about a year ago, you see this divergence where, yes, prices were rising, MSRPs rather, were rising for non-electrified cars at a low mid-single digit clip. But from the electrified side, prices are now 20% higher year over year in the third quarter than they were previously. So the spread between paying for a new electrified car around 60,000 versus a new non-electrified car around 40,000, it's a $15,000 to $20,000 spread, and that upfront delta, while you will get payback in OPEX savings as a consumer in lower fuel and maintenance costs, that's not the trend, I think, that those OEs who are massively investing in electric vehicles are hoping to see, because that spread, that 20,000 in incremental financing, well, a 5% incremental finance cost, that's another $1,000 then in interest atop the non-electrified vehicle, all else equal, right? So it's it's been a bad trend for affordability in the automotive space. You should see this continued alleviation of the supply chain bottlenecks, bringing supply to market. So even with a weakening demand picture for automobiles, that's the expectation, I think, from OEs, is that generally 2023, it's not like it's going to be 2009 with everything going poorly, to say the least. Now, obviously, you saw the head of Tesla, or maybe you didn't see him tweet today, griping about Federal Reserve interest rate hikes again. So it does seem like the premium automotive space is being hit perhaps a bit more, but remains to be seen what happens there. Okay, continuing through the asset bubbles popping, then we can segue naturally to a little bit of a supply chain discussion. Before I conclude the prepared remarks, we had really this begin under the prior administration, this idea that the way in which the relationship between China and the US and others had worked was really unsatisfactory. You had the former president, of course, conduct his trade wars with tit-for-tat tariffs, and that happened. And then, of course, COVID happened. And as we were talking about with the bottlenecks and the supply chain issues on automotive, all sorts of global supply chains were thrown into various different problems. And now we're seeing Apple, the world's most valuable, one of the world's most valuable companies other than Saudi Aramco, they're now accelerating their plans to shift some of their production outside of China. So, it's kind of fitting to see that somebody who's really the success story of Apple has been their incredible supply chain efficiency that they realized through almost solely sourcing it into China in these Foxconn facilities and other supplier facilities to assemble their products, has really taken a big step back. So not just leaving China for adjacent countries or nearby countries like India or Vietnam, but also we see that Apple is bringing back some chip production to the US for the first time. So the Wall Street Journal reporting was last week. Other media outlets reported it, that Apple's looking to further diversify that supply chain outside of China on the back of those protests, not solely because of those protests from workers in the Foxconn iPhone city, but that they're looking to get more than just sourcing from China, and that'll involve them leaning on production elsewhere. So there was also, of course, a lot of industrial policy from the U.S. side of things. Like him or hate him, the current president has overseen the passage of several meaningful pieces of legislation that should accelerate this trend toward reshoring certain production. So We had the Chips and Science Act, which I pulled just from McKinsey's analysis. I have that on screen. You can see McKinsey, saying that they expect to see close to 280 billion in spending over the next 10 years invested into chiefly science, technology, engineering, math, R&D, workforce, and economic development program authorizations. So advanced chip making is really the big thing, and the goal is to bring that back stateside. And lo and behold, Taiwan Semiconductor Manufacturing, TSMC, the world's largest and most advanced contract chip maker, had reported this week that they are bumping up the investment they expect to make in a second factory in Arizona, which was, I think, an incremental almost $30 billion of investment. So a pretty big number. And it had initially been a $12 billion investment plan to build that first factory. So now there's going to be a second factory with construction starting in 2023 and production to begin in 2026, while the most advanced TSMC chips wouldn't be built at the first factory. The reporting says that the second factory will make the 3 nanometer chips in Arizona. So this is good if you are on Team America. I think you're going to see that continued investment from major players like TSMC, Apple, and others into domestic manufacturing from the chip making side of things. And then, of course, there was the Inflation Reduction Act that was passed recently as well, which contains more than $500 billion in new spending and tax breaks to boost clean energy, reduce healthcare costs, and increase tax revenues. So I think the name is kind of silly, right? Inflation Reduction Act, obviously very politicized. I mean, clearly the intention of this is not, it's much more an industrial policy and an investment in these new technologies or newer technologies like carbon capture, energy storage, clean hydrogen, trying to commercialize those and drive investments in domestic manufacturing capacity. So most of it, though, is energy. 250 of the roughly 400 billion McKinsey estimates is energy. About 50 is manufacturing, another 50 is environment, and then transportation, electric vehicles, agriculture, and water round out that federal funding. So big swathes of funding coming to build out and reinvest in domestic manufacturing and supply chain. So I noted a healthy heaping of carrots to lure those on the fence back stateside. There was a good article, another writer that I'm a big fan of, Greg Ip at the Wall Street Journal, had noted that there's really an opportunity for the U.S., with that Inflation Reduction Act, right, which is very much rewarding domestic U.S. production. However, that could be at the expense of, say, if you're a German automobile maker who's invested in EV manufacturing supply chains in Europe, you may feel disadvantaged, right? And it makes the point that the U.S. and Europe, right, are allies. This Inflation Reduction Act shouldn't be causing tiff between the allies. It should be, can the U.S. kind of structure this so that when we're talking about these benefits going to different companies or different participants in international trade agreements, that's not just talking about the new NAFTA, the whatever it's called that the former president shifted a NAFTA into, that it incorporates both like South Korea, Japan, and the EU, so that there isn't necessarily a acrimony between the allies. So yeah, we'll see what happens there. But these major investments are definitely leading to companies continue exploring China plus strategies. One of my favorite transportation uh, publications, Transport Topics, had a good write up last month talking about how supply chain challenges have accelerated that reshoring and nearshoring trend. I'll lift a few of the kind of comments and data points from there. So, for example, the executive director of the Reshoring Institute, which, as the name implies, is trying to encourage reshoring of domestic manufacturing, noted that they're seeing Chinese companies by the hundreds popping up on the U.S.-Mexico border as an alternative to just sourcing from China. So it could be sourcing from China and Vietnam, Malaysia, or Thailand, which they note would be at up to a third of the cost. So it's still lower cost, but you do have a more fragile supply chain, a longer supply chain, a less resilient supply chain if you're reliant solely on Asia for sourcing. So you do see this continued interest in sourcing from either North America, the U.S. itself, joining countries in Latin America or Canada. The point that is made is that goods coming from China are still subject to that 25% penalty tariff. If you manufacture in Mexico instead of China, you're getting a 25% savings on cost, and also benefit from the advantageous duty treatment under the USMCA. That's right, that was the name of it. U.S. Mexico Canada Agreement was what NAFTA became. So some data points from some different reports out. So the 2021 State of North America Manufacturing Report found that 83% of manufacturers are likely or extremely likely to reshore by adding North American suppliers. And that was up from 54% in March of 2020. So a pretty meaningful increase since COVID in terms of how many North American manufacturers are likely or extremely likely to add North American suppliers. And the finding from that was that if those 4 of 5 manufacturers brought just one new domestic single contract supplier online, it would inject almost $500 billion into the U.S. economy. So we're not talking, pennies here. It's certainly a significant amount of money. A couple other data points. So I've followed this one for a few years. The third-party logistics study, which is the CSCMP, the Council of Supply Chain Management Professionals, that report came out last month and found that 80% of shippers surveyed have taken or are planning to take action toward rebalancing production locations to move toward more regional or domestic product networks. So there's clearly been a big uptick in the mix of manufacturers who anticipate bringing supply chains closer to their end consumer, the American consumer, right? And that's not just a cost-driven decision, or at least not direct cost, because the points around things like supply chain resiliency, you could have the most efficient supply chain, the lowest cost supply chain possible, and that's what many companies had before COVID, but that's not a very resilient supply chain if it's single sourcing from one or a few suppliers in a far-flung part of the world that's at risk of being shut down on a whim, right? So it definitely seems like resiliency, being willing to pay the cost of either higher inventory levels or not having just a single source. Maybe you're going to pay a little bit more to have multi-source supply chain. That's something that's become vogue. It's continuing to happen. It does seem like from all of these reports this year that those numbers are at or near peak levels in terms of the expectations. Another kind of line of commentary from the chief investment officer of 3PL, third-party logistics firm GXO, which used to be XPO, but that's their contract logistics company, noted that COVID made supply chains longer, slower, and more complicated. working capital is tied up longer, goods are unable to get to market in a timely manner, then they have to get discounted, which then you cut margins. So he noted that customers cite the need for diversification of supply and manufacturing, improving cash flow, reducing inventory obsolescence, and bringing goods closer and faster to the consumer's last mile as a driver or as drivers of reshoring and nearshoring. Quote, instead of bringing thousands of goods in China, bringing it onshore, you can manufacture onshore or nearshore and personalize it. Customers want the opportunity to get really close to the consumer. So certainly good if you're a 3PL like GXO, good if you are someone reliant on transportation or that provides transportation services and logistics services in Mexico, in the US, or in other reshoring and nearshoring locations. Good for industrial real estate and storage facilities as well. So the story further notes that many of the hottest markets in the US, like Phoenix, like from that TSMC story we talked about just before, Austin, Texas, they're facing capacity constraints as new businesses move in and set up in those compressed markets. There's just more and more pressure on third-party logistics companies to find space for them, to source workers, to manage the facilities, and to support that reshoring move. So it definitely isn't an overnight phenomenon. It's a long-term strategy, and it's something that's going to take years to continue to see play out. But I think with these policies that have been passed from the federal government, that really offers some significant carrots for those who go down this journey, plus the lived experiences of a lot of these manufacturers and producers over the last few years, it does seem like nearshoring and reshoring is more attractive now than it really has been before. Before I wrap, I'll just add a couple more data points. So this was from Deloitte about a month ago. They put out a future of freight report, and they noted that U.S. companies will reshore 25% more jobs in 22 than in 2021. And it is in that pursuit of resiliency, like I was talking about, that it may not be the absolute lowest cost from a direct cost perspective, but when you consider the value of that resiliency, it appears like the path that manufacturers are going down. Their report found that 62% of manufacturers have started reshoring or nearshoring their production capacities. So again, started doesn't happen overnight. Companies could be anywhere in that, just like with TSMC, that factory just getting announced this week that'll be done in 2026. But it's definitely good to see. American firms are expected to reshore almost 350,000 jobs in 22, is that 25% increase. And ultimately, Deloitte finds that the shift could reduce by 20% the share of Asia or originating shipments to the US by mid-decade and by 40% at the end of the decade. So they see it as an ongoing trend, and that simply means a lot more domestic freight. So that, I think, is very bullish for domestic freight and supply chain and third-party logistics managers as we continue to see the impacts of reshoring play out. So last graphic, just before I wrap the prepared remarks, is a graphic from that Deloitte report, that Future of Freight survey, that shows where the expectations for reshoring are highest. And you can see that it's highest in the Midwest, the South, Texas in particular. And if you think about labor, it's interesting. There was General Motors Ultium plant voted just to unionize. I think it was just today. So that was one of their new battery plants that they built in, I think it's the Ohio one. So interesting to see, where in the country people opt to place these facilities, because generally manufacturers prefer to find lower cost labor, and Texas, being a less union friendly state, does seem to make sense. Also the proximity to Mexico, if there's cross-border shipments involved. So definitely a lot of hopefully useful information, maybe information you haven't heard or seen before, that I was happy to share about the trends we're seeing in reshoring and nearshoring. Joe, that's what I've got this week for the prepared content.
I'm going to invite up some people to speak, some people we're used to hearing from here.
All right, so yeah, I mean, I nerd out on this stuff. I obviously have been closely connected to the supply chain industry from a professional standpoint for many years before joining Wook. There's a lot of positive implications for the domestic economy, I think, from these trends toward nearshoring and reshoring. And it brings jobs, it brings growth, it brings investment. It will certainly be interesting to see as these supply chain bottlenecks and constraints that were experienced in COVID start to fall out of people's memory. Do they perhaps not execute on as much of this as they maybe thought during the most grim times? So I'll be very interested as the supply chain kinks iron themselves out further. Do we start to see a reversion back down from some of these elevated expectations of reshoring and nearshoring? And there's certainly people who have that view that it's not going to happen. It's just too expensive for many people to bring manufacturing capacity and capabilities back to the States or to Central America. But still, it does seem like the China single source, supply chain of maybe the 2000 and 2010s is going to go away. And there's been a lot of shifts even from early in the Trump administration's trade war into adjacent countries or nearby countries in Southeast Asia. So you think about places like Vietnam, places like India, that Apple's making investments in. Those countries will likely continue to receive some of the folks leaving China. And if it's a low cost, low complexity good that maybe doesn't change that regularly or need customization or need to be in a shorter supply chain, then sure, it could probably be just fine if it gets exported from a port in Vietnam versus a port in China. But it definitely, the U.S. has made some pretty big strides in terms of those industrial policies that they passed, I think, that will encourage a lot of investment in a lot of these future tech kind of segments for most of the decade to come. So yeah, it's 4:40. It looks like it's a little bit quieter in here this afternoon. If anybody wants to come up, chime in, ask any questions, happy to explore topics in addition to what we had in the prepared content. Otherwise, we could certainly make it a shorter one this afternoon and let folks get on with their weekend.
Yeah, we've had quite a few discussions this week doing the GME earnings and the open mic on Wednesday. So it's definitely been a packed week. But I will add, I mean, remember back when everyone thought China was going to overpass the U.S. and become the biggest economy in the world in the 2000s, and everyone thought that was going to happen, in the next few years. And look at it now.
Yeah, that's a good point. So I just Googled it. This is a Newsweek article. The headline is, and this is from a month and a half ago, the headline reads, China quietly abandons goal of overtaking U.S. economy. So at the recent party Congress, in their two-step plan to double the country's wealth by 2035, yada yada yada, they are no longer explicitly having that call to become the world's largest economy. So they originally had a 2035 target, including that, and the newest version has omitted it. So perhaps there's a realization on their side that they do have population decline coming through and coming down the pike, and the U.S. is quite resilient, and who knows if it'll happen or not. But interesting that they explicitly are no longer calling for that. And here's a graphic for those of you who are in the room and can see the screen, kind of showing where GDP has gone to through 2021 at least. So, really, obviously, since the early 2000s, China's admittance to the World Trade Organization, a few decades back, really jump-started so much investment in China. And there's a lot of negatives that come along with that, losing intellectual property rights, having to deal with a lot of human rights issues, Xinjiang, of course, and then of course with COVID zero, which it does seem that this week they've really officially pulled back. Well, let me not say officially. They've unofficially kind of ended the COVID zero, the idea that they're going to allow people now to shelter at home as opposed to being forced into different quarantines if they are asymptomatic or whatever. Like there was a bunch of different rights, I guess, given to the local municipalities in China to kind of manage their COVID at a local level and not just have this kind of blanket zero COVID policy. So the China reopening story we'll see, I think, play out over 2023 as it comes back online. But yeah, uh, made in the USA seems to be resurging. And folks, if you want to submit questions, comments, again, you're welcome to come up. I went through all the prepared material. We definitely are happy to dive any further in or pivot and take the discussion elsewhere. It's 4:45, so if not, we'll wrap things up in short order here for this week.
Yeah, I will say it's nice to see the Made in America not be as politicized. I mean, under former President Trump, people thought this was some right-wing initiative to make things in the U.S., and now it's actually being seen as a viable option for many companies, and it's not as politicized. So that's good. People understand that there are benefits besides just being on the right.
Yeah, I think the problem was that, like a bull in the china shop, the former president wasn't very good at communicating with others and kind of went forward with this tariff driven policy, including tariffs on allies, without maybe working in collaboration with those historical allies. And obviously, he has his own viewpoints um, that aren't so favorable towards some of our historical allies. But I know my view at the time was that it would have been a better approach that might have been better received had he worked with allies to get some of these policies kind of to rebuff China. But regardless, the current administration has opted to spend a whole hell of a lot of money on these initiatives. So it's definitely very different approaches, right? The former president's approach was very much a stick at those Chinese exporters, and the current president's approach is a carrot towards the U.S. manufacturers. Um, Although he has kept up, I think, a lot of those tariffs that the former administration had in place. So maybe they're a little more alike than they like to admit. It does seem like something does have to get done about this disconnect between the way the Inflation Reduction Act was structured, really leans on domestic manufacturing of battery, uh, the battery componentry that go into electric cars is a really big part of it. And if you're South Korea, if you're Japan, if you're Germany, you're a U.S. ally, and now you've made these major multi-billion-dollar investments into manufacturing in your country, and now your products are going to be disadvantaged in the U.S. And maybe the response would be, well, America first, America. But from a global geopolitical strategy perspective, it might have been better, and maybe the U.S. needs to kind of restructure that. As I was saying with kind of that article from Greg Ip that I have up on the screen too. I think there's a low, no-cost way, right, for the U.S. to still encourage electrification investment if they kind of just make it that, yeah, if we have a trade agreement with your country, like we do with many EU countries, you're going to be able to benefit from those EV subsidies too. But we'll see what happens. One thing's a fact: countries love to shell out money for electric vehicle subsidies. Joe, there's my Taycan. You see it right on screen?
It does better on gas than my car.
That's right.
Doesn't need all the dyno fuel.
No dino juice needed in the operation of a Porsche Taycan. Okay. Well, look, we went through the content this week. Clearly, it's the end of the week. Smaller little crowd here today, and no one's opted to come on and chime in. So I'm going to wrap it up early this week and just kind of recap what we have coming along in the near term. So we are going to round out the year next Friday. Will be our last Wook and Review broadcast of the year. I'm working on a survey. I'd really like to understand. We put out our first short form video last week or earlier this week, whenever it was. I filmed it last week. We put it out this week, but we put out a short form 2-minute video on an on-site kind of due diligence video, and we're going to try to better understand what Wookiees, what people that we consider part of our little ecosystem we're trying to build here want from us, and how they want to engage with us, and what are the ways in which we can deliver value for them, and hopefully see value from what they're willing to share with us and what they're seeing. So we will have a customer survey coming next week. In next week's newsletter, I think I will include the link. I'll also publicize it on social media. We have that book club on Tuesday that I really look forward to, and I hope that we'll have some great participation. If you have not read Howard Marks' The Most Important Thing, I encourage you to take a peek at it. And even if you don't get a chance to read it and you just want to join and listen in on the conversation, you are certainly welcome. I hope that you'll learn something to add to your investing toolkit, or at least how you think about investing. And as I have mentioned a few times now, we do plan on, as 2023 rolls around, beginning some more regular coverage and putting out some more explicit analyses of different securities and different companies in the market. So we've obviously hosted a couple of calls on PLBY and on GME. We will be hosting a slew of calls come fourth quarter 22 earnings season in early 2023, and that's going to be a quarterly cadence from us going forward. If there are different mechanisms by which we can deliver information effectively, and if you have any feedback for us on how we can make this more valuable for you, please, we're all ears. We're trying to learn just as much as everybody else. So, Joe, anything I left out?
Nope. Well, we've already covered everything. We have the book club coming up. It's already been mentioned. Yep. Definitely, we check it out. We have a PDF for the book for anyone who hasn't had a chance to purchase it yet. Skim over it, tune into the discussion, and even if you haven't read it, there's going to be plenty of stuff to talk about. So that's coming up soon.
Yeah. So great. Well, thanks everybody for tuning in and listening to our 12th Wook in Review. I hope you have a great rest of your weekend and stay safe out there. Cheers, everyone.